Well, happy Friday to everyone. This is Friday, August 19th, halfway through August already. Year is flying by for some good reasons and for some other not great reasons, but it is certainly flying by. I'm Brian Peluso, one of the partners and financial planner here at HPK Provident Advisors with offices in Pittsburgh and Sarasota, Florida. And of course, I'm joined by star of the show, Mike Kutch. Mike Kutch is a chartered financial analyst and spends his time at our firm working on the portfolios for our clients. And so every Friday we get together and just chat about a few things, take a look at what's happening in the markets and get some insights from Mike. Important to note, nothing that we are going to talk about should be construed as specific recommendations. You'll obviously want to work with your qualified financial professional, qualified tax professional, and qualified legal professional to get specific recommendations that are customized to your circumstance. So this is just informational. We love talking about the markets. It's always fascinating. It's constantly changing, and there's been a ton going on this year. So every week, 12:30 p.m. Eastern Standard Time, we jump on Facebook Live and just provide you some thoughts on the markets, and then we'll talk a little bit about some financial planning concepts as well. All right, Mike, what's going on?
Yeah. So equity markets have been pretty flat this week. Based on what's going on today, we're probably going to finish a little lower for the week. Nothing too substantial. Last Friday, I referenced the 200-day simple moving average, which is around 43.20. And sure enough, the S&P got right up to that on Tuesday before bouncing off of it and drifting lower. After the strong rally, the 200 days seemed like a logical place for the equity market to, just kind of take a breather, do a little consolidating.
Right. Now, that's the moving average. That's something that you've referred to before. You just mentioned the simple moving average, right? And last week you were referring to an exponential moving average.
Yeah.
What's the difference?
That's a good question. There's so many different technical indicators and even in terms of moving averages. So the main difference is the exponential moving average. It places a greater weight on the most recent time period. So it could potentially give you an earlier indicator of a trend continuation or a trend change. But with that, it can also give you some false signals. I did hear from one technician this week on CNBC. I think it was Jonathan Krinsky. He said whenever the 200-day is downward sloping, the market usually takes a few attempts before it breaks out. So we could very well bounce a little lower here, get back up to it, bounce a little lower, and then ultimately we will break out of it at some point.
At some point, and that's the big question, right? That is the big question, and it's this is another thing that we had talked about a couple Fridays ago. The fundamental analysis, technical analysis. It seems like the technical analysis really plays into the markets the way they are now. I mean, is that more helpful, less helpful? Talk a little bit about the technical analysis and how it fits.
I mean, it's really funny and interesting that a lot of times they'll go hand in hand. So right now on the technical side, there's some improvement out there on certain momentum and breadth indicators, but we are getting an oversold condition. And you look at how it looks fundamentally, we're also getting a little expensive. We're about 18 times 2023 earnings, which isn't that expensive in the past couple of years, but it is above historical average. So it's interesting how they can kind of work well together. But yeah, in times where there's a lot of market movement, technicals are very useful to me. I'm going to shift a little more to that fundamental front and talk about some of the headlines this week. Cool. So we got retail sales were the big one and the Fed minutes. So first, retail sales, they came in flat for the month. But if you take out either energy or autos, we would have been positive for the month. So overall, not a bad reading. The main area of strength occurred in online sales. And that was most likely the result of Amazon Day occurring for the month.
Love it.
So I know I made a couple purchases that day. How about you, Brian?
Well, my credit card was used on Amazon quite extensively. I wouldn't say I made purchases directly, but yes, we participated.
The risk of being married. And then on the Fed minutes, I'll touch on those a little bit. They are 3 weeks old or so at this point, so we've seen some improvements in inflation and employment situation. So I'm really more interested to see what the Fed has to say at their Jackson Hole symposium next week. I think that occurs on Thursday and Friday. So I think Powell gives a speech, and we'll hear from some other Fed members. But based on the minutes and just some of the Fed speakers I've heard in the past couple of weeks, there seems to be some debate growing within the Fed. So some members are concerned that they're going to hike too much into a recession. Obviously, I'm sure all of them are have that in the back of their mind. But others seem more concerned about not fighting inflation fast enough and hard enough. So a lot of that group really thinks we have to go much higher than the neutral rate, which most of them do believe we're close to the neutral rate right now. So right now, if you look at the bond market, what they're pricing in, I think it's around 3.6. But then they have the Fed lowering rates in 2023. So based on the minutes and the Fed members, they see getting to that terminal rate and staying there for longer. And that makes a lot of sense to me. Why are they going to go so aggressive raising rates and then just ultimately back off from there? So unless there's substantial decline in inflation that's sustainable over months and months, and or the latter would be if things really deteriorated economically, there's really no reason for them to back off on rates. And if you look historically, they've never really gotten inflation down without the Fed funds rate being above inflation. So getting to a terminal rate of 3.6, we might have to get closer to 4%. So what that would really look like, say we get a 50 basis point hike in September, a 25 in November, and a 25 in December, that puts us at 3.25 to 3.5 range. So potentially doing one or two more 25 basis point hikes in 2023 before pausing would make sense to me.
Interesting. Now, the Jackson Hole Symposium, obviously Jackson Hole, Wyoming, that's a conference essentially. This isn't an official Fed meeting where we're going to see a lot of quotes and we're going to hear a lot about what's talked about at the symposium, but there's really no specific action they're going to take next year.
No, they're very unlikely to do a rate hike. That would be very out of the norm for them to do one between like an official meeting. The next official meeting, I think, comes in the third week of September.
Oh, okay. And then that's normally when they're announcing what they're actually going to do. Right?
So we'll get another inflation reading and another jobs reading before then. So it could really alter their positioning.
So let's get a little bit more specific as we can. Of course, this is general information, but how about from a portfolio perspective? What kind of updates, adjustments, anything you could speak to there?
Yeah, so I did add a little bit of equity exposure last week, mainly through a few individual securities, not any big moves. Like I hinted at last Friday, it was more in the growth stocks because I think those type of stocks can do well in a slowing growth environment, and that's where I believe we are. And then I also added a natural gas company. Just the difference between natural gas prices in the U.S. and Europe is crazy. And with winter coming, demand's going to be very, very strong over there, and supply is going to be short with the war going on. So I think that's a pretty good space to be. But overall, we still have a very healthy cash position because I see at least a modest pullback coming September or October. September is usually pretty seasonally weak, and if we get any disappointment in inflation data or material cuts to earnings, that could cause things to pull back. So overall, I think we'll get an opportunity for better prices. And what that pullback could look like, maybe 5%. I don't think it's more than 10%. We've had a lot of improvement on the technicals. So from stocks above their 200-day moving average now is above 50%. Stocks above their 50-day.
Mike, you with us? All right, we're going to take a little
Hey,
pause.
moving average. Am I back?
You are back.
Okay. Well, that was
Nice
pretty
work.
much.
I was going to have to do a little song and dance over here or something. I'm not good at either.
That was pretty much the end of my spiel anyway. So.
Fair enough. Fair enough. Speaking of portfolios, I heard this twice from two separate folks in social circles. Twice this week, people said to me, "Oh, I quit investing for now because the market's not really great." And that's kind of subjective, right? If we all want positives in all of the investments that we have and all these other things. But I found that to be counterintuitive, really. This could be for longer term investors. You've got 10, 15, and these folks I was talking to, they had 15, 20 years that they were planning out for retirement. And they said, I'm on a pause, not putting any money back into my retirement plan at work. And it's counterintuitive because you could look at it in one way as the stock market's on sale, right? And on Amazon Day, everybody goes out there because everything's on sale and they load it up and say, oh, is it this great? The prices are much lower. And investments kind of work the same way. If you're putting the same amount of money in, call it whatever time frame, monthly, quarterly, annually, if you're putting the same amount of money in and the price of those investments is lower, you're probably going to end up with more shares. And if you're buying good quality investments, things that are appropriate for your time frame and for your risk tolerance and your risk capacity, it's most likely that those, it's just pretty likely good quality investments are still going to be here next year, the year after, and the year after. And right now, you get them on sale. And so, but of course, that is very specific to each individual, specific to their financial plan. What those goals are, how much they need to be investing on a regular basis to achieve those goals or be most likely to achieve those goals. And for some folks, this does get to be stressful, but that's why we're here. We can, pull back, be a little bit less emotional on the investing, get back into the financial plan, see how the numbers work, even in a year when some of the markets are down, that we can go right in, check out that financial plan, and hopefully encourage people to stay on the path to those goals. So in reality, if we go back in history, there have been many years where it would have been very, very helpful to continue investing, even though the headlines were negative, whether it be world headlines or market headlines or political headlines or whatever it is. But history would prove that those were often really great times. So I would encourage everybody a couple things. If you've got a good plan, if you've got a goal, you've got your time frame, and if you are moving towards that goal by investing on a regular basis, the two cases I was talking about, it was into the retirement plans at work, and they had quite a few years for their goal. We would encourage you to take a look at your plan, take a look at your time frames, remeasure even in a year like this, if it still makes a lot of sense. And oftentimes it does, to continue working towards those goals, like any goal in life, right? I've been trying to lose weight forever. I can only do it 1 pound at a time, so, but, you got to do it a little bit at a time. And that's the way a lot of the financial goals are as well. So that just, it came to me, actually, one of the conversations was just last night. And I thought, wow, I hope there isn't a whole nation of people that are saying, I'm not investing anymore. It's not a great time. Well, it's probably a better time now than it was, say, last year or the year before, because markets were up and the prices were high. So that's just a quick thought on that.
Usually, if you're scared and nervous about things, it probably means it's a good time to buy.
Was it Warren Buffett that said, or was it Templeton that said, buy when there's...
Oh, yeah. Warren Buffett has one that is, be fearful when others are greedy and greedy when others are fearful.
Well, there we go.
I love that one.
He's done pretty well for himself. So
I think so.
That's what we've got for this Friday, August 19th. We'll be back next Friday, 12:30 p.m. Eastern Standard Time. We'd love to hear your feedback. If anybody would like us to address specific topics, we can't get really into specific investments, but we can talk about specific topics. So if anybody has any questions, things that you'd like us to talk about, or just feedback in general, please let us know. Everybody have a great weekend. Mike, thanks again for your time. Yeah, and we'll talk to everybody next Friday.
Okay. Bye.
Thanks. Bye.